Hello, my name is Denise Appleby, and I'm here with my friend, the brilliant Lois Robinson, CPA, who's also a financial advisor. And we're going to be talking about qualified charitable distributions. Why? Because we've been getting a lot of questions about that topic. And it appears that there's a lot of confusion about how the rules work. And part of that confusion stems from the fact that the responsibility to ensure that this amount is excluded from income rests with the client, because the IRA custodian has no responsibility to report these in any special way, which is one of the reasons I thought, why not bring in someone who knows about tax reporting on tax returns because he's a CPA, and is also right now actually on the financial advisor side. So he can help you on both ends. Hi, Lois, how are you?
I'm fantastic, Denise. Glad to see you today.
I've been talking about the fact that you used to operate as a CPA. You're still a CPA, but now you operate as a financial advisor.
Yeah.
So would you mind giving us a little bit of background on who you are and what you do?
Well, I was a CPA for many, many years and retired and sold my practice. And I was going to do retirement planning within the CPA firm. And I found out people don't like to be billed for that. And that's the only way CPAs know how to generate revenue is billing by the hour. So I joined a financial firm, well, this is 12 years ago, and worked with them, started an office here in McDonough, and built it a lot of it on tax planning, and particularly I did a lot of retirement planning for us, people who are charitable, and particularly when the QCDs became popular, I did a lot of work on those and a lot of work on donor advised funds, which is one of my passions to work in that particular area.
Yeah, we got
Right
to talk
now,
about that one of these days, donor advised funds.
that's another area people should be aware of because it can save you a lot of taxes.
Yeah. Louis mentioned that he lives in McDonough. Before I cut you off, Louis, is there anything else you wanted to add to that?
No, that's it.
So I'm in Georgia and I'm close enough to Louis so that we get together to grab a bite. And I love that. Thank you for doing that. Get me out of the house. My name is Denise Appleby. They call me the IRA Whisperer because I've been known to be able to take the complex laws that govern IRAs and simplify it so that anyone can understand it, regardless of your levels or level of competency when it comes on to traditional IRAs, Roth IRAs, and employer plans. And hopefully by the end of today's session, we will have simplified QCDs enough so that you can in turn have that conversation with your clients or your advisor about QCDs. Let's start by talking about what's a QCD. Louis, you give your take and I'll give my take, and then we'll go on from there.
It's a qualified charitable distribution. It's a distribution that you take out of your IRA when you're 70 and a half years of age. It's not the year that you're 70 and a half years of age. It is the day that you're 70 and a half years of age. You can do a QCD. Also, when you get to the point where you're having to take out required minimum distributions, you can take out a QCD and it satisfies that required minimum distribution. For instance, if you had a required minimum distribution of $40,000 and you have charitable goals that you say of half of that, 20,000, you can send that 20,000 directly to the qualified charitable institution. You take the other 20,000. So when you file your tax return, you have taxable income of only half of that. And the part that goes to the charity is not taxable to you. And it has to be a qualified charitable entity. And Denise, you might explain what are those entities that are qualified?
Yeah, absolutely. So high level, a QCD is a qualified charitable distribution. that can be made from an IRA. We'll talk more about that later on. There is an annual cap for 2024. It's $105,000 index for inflation, which means next year it might be higher. And as Louis said, the charity has to be an eligible charity defined in the code, Internal Revenue Code section 170. And so the question becomes, how do I know? Let's say I was making a QCD. How do I know if the charity is eligible? You can ask them. If I have an advisor whose clients make donations to their churches every year, tithes and offering, that's an eligible organization. So instead of putting your money in the collection plate every Sunday, if you have an IRA, have your IRA custodian send that collection amount from your IRA to make it payable to the church. They can send it to you as long as they make it payable to the church. You hand it to the church, and guess what? It's excluded from your income, like Louis said. So when your accountant does your tax return, that amount is excluded from the line that says amount included in income. What a great way to make a donation. Have it excluded from your income. How easy is that?
And the other thing it does, not only does it exclude it from your income, it lowers your adjusted gross income. And when you lower your adjusted gross income, that can have an impact on a lot of other things on your tax return. For instance, you can, if you're itemizing, you might be eligible for more medical expense for that. There's an IRMA charge, which is excess Medicare premium that you have to pay when your income's a certain level. If you can get your adjusted gross income reduced, you can reduce that too. So there's a lot of other areas when you reduce your adjusted gross income can have an impact and save you taxes.
And that's why I love the fact that you are in both sides, because you can have a broader conversation about the real impact of making a QCD instead of making a donation out of pocket. So we sort of touched on this already. Who can make a QCD? As Louis said, you have to be at least age 70 and a half in order to do it. Don't confuse this with the old RMD 70 and a half rule, where you had to start your RMDs in the year that you reach age 70 and a half. As Louis said, this is on the day. So if you're going to be 70 and a half tomorrow, don't make your QCD today, because it won't be a QCD. You gotta wait until tomorrow. This is one of the things that you touched on too, Louis. You said QCDs can be made from IRAs. And anything else you want to add to that?
Well, it's IRAs or simple plans, anything that's really an IRA. It's just not it can't be like from a 401k plan or 457B or whatever. It strictly has to be IRA. Of course, you can roll funds from your 401k and other plans to an IRA, and then you can do it.
Excellent. So anything that ends in IRA, there's an exception to that rule that says if the simple IRA or the SEP IRA is ongoing, then you cannot make a QCD for the year that a SEP or simple contribution is made to the account. So if you're making a QCD from your SEP or simple, check to make sure that no SEP or simple contributions were made to the account for that year, because then for that year, the SEP or simple would not be eligible to make a QCD. You know what, too, Louis? What a lot of people overlook too is the fact that when you and I say IRAs, we're talking about inherited IRAs as well. So if you have an inherited traditional IRA, inherited Roth IRA, as long as you're at least age 70 and a half, you can make a QCD from that inherited account.
A lot of people are not aware of that, and I know in the past I've looked it up because I wasn't for sure, but talking with you and also looking it up, you can do it from an inherited IRA.
Yeah. So, there are a lot of beneficiaries out there who are charitably inclined, and this is an opportunity for them. Now, we're not saying to people, oh, go get your IRA money and make a donation. We're saying if you are going to be making a donation anyway, this is a great way to do it.
And one of the other major reasons it works is so many people, when they're at that age, 70.5, the standard deduction now is so high, they can't itemize, which means any donations they make, generally, they're not going to get a tax benefit unless they make a large donation, and it's still going to lose a lot because a couple over 65 or so, it's around $29,000 or so for a standard deduction now. So if you don't have mortgage interest, taxes, and taxes can only be 10,000, you're not going to get any benefit of your charitable donations, but with a QCD, you will.
Excellent point. And part of what you teased earlier is you can't do this from a 401k, a 403b, or any other employer plan. You simply cannot. But if that's where the money is, you could roll over those funds to your IRA and then make the QCD from the IRA. But here's where you got to be careful. If you are of RMD age, which now would mean you're at least age 73 by the end of the year, you're going to have an RMD from that employer plan. And you got to take the RMD before you do the rollover. And part of what Louis said earlier is your QCD can count as your RMD, but that's for your RMDs for your IRAs. And part of what Louis and I are going to cover later is how do you make sure that that happens? Your QCD covers your RMDs if that's what you want. Anything to add to this, Louis?
Well, let's talk about what if you had basis in that plan and you wanted to get it to an IRA so you can make charitable donations.
Absolutely. We're good, excellent point. We're going to touch on basis later on in the program because that's a question that comes up. What if I have basis in my IRA and I want to make a QCD? How does it affect me from an income tax perspective? Excellent comment. Oh, now, Louis, let me tell you something. I wrote an article for Horse's Mail some months ago, and I explained in the article that you can make your QCD from any type of IRA, as you correctly said. And one of the advisors said, you cannot make a QCD from an IRA. And I meant to say Roth IRAs. So I had to pull out the authoritative source that says, yes, you can do it. But the question becomes, Louis, how would that work? Because let me paint you a scenario. If you have $100,000 in your IRA and 50,000 of that is after-tax funds, if you tell your custodian, send $100,000 to the charity as a QCD, only 50,000 really counts as a QCD. The 50,000 that's non-taxable would not count as a QCD because the whole point of the QCD is to exclude it from income, and that amount is already excluded from income. So, his point was Roth IRAs are tax-free anyway. How am I going to make a QCD from that? And what I explained to him is that the portion of a Roth IRA that would count as a QCD is the non-taxable portion. I mean taxable portion. But here's the thing to remember. If you have taxable funds in your Roth IRA and you take a distribution, the ordering rules apply. And under the ordering rules, your taxable portion comes out last. But so he's thinking, Houston, we have a problem. And I explained to him that for a QCD, the rules are flipped. The rules are flipped, making your taxable portion coming out first, which means that the distribution of earnings, in this case, if it's used as a QCD, would in fact be non-taxable. So the question becomes then, what if you have a Roth IRA, 100,000, 5,000 of that is earnings, and you make a QCD of $5,000? It comes from the earnings, it's excluded from income. But if you make a QCD of $10,000, then the extra $5,000 is not a QCD. Your tax preparer has to report it as non-taxable, but because that portion is not treated as a QCD, if you itemize, you can claim it on your tax return.
It's just like you took the money out and wrote a check for it. It's an itemized deduction. And one of the things I just want to mention here, because it's really important, there's a court case regarding it, is you got to have receipts for these donations that come out of your QCD. You got to have a contemporaneous receipt when you make it. You better have it before you file your tax return, because you could have it disallowed if you don't have a receipt for it.
And the receipt has to say, you gave me money as a donation. I didn't give you anything in return.
The goods and services received, period.
Exactly.
Yeah, there's a qualified statement. And I'm sure you've seen a lot of them that you get from charities, and that should be on that receipt when you.
Yeah. I was a board member on a charitable organization, and we made sure that the acknowledgement letter to clients for their donations said that in black and white. You gave us your money, thank you. We didn't give you any considerations for it.
And we've had problems with clients being able to get receipts when they made qualified charitable distributions. They've had to follow up with the organizations to get those. And I always tell them, you better have it before you file your return.
We're going to have a conversation with those charities.
Well, particularly during the COVID period when they were, they were not totally staffed. And I think that was some of the problems during those period of time.
Now, QCDs and basis amounts in traditional IRAs, this is what you teased earlier on. If you have after-tax amounts in your 401k, for instance, and you roll it to your IRA, that creates basis in the IRA. But just like Roth IRAs, where for non-taxable portions, the basis in your traditional IRA don't really count as QCDs, but you can claim them if you itemize. Now, here's the rules that's different with traditional IRAs. Typically, if you take a distribution from your traditional IRA, if you have basis and pre-tax amounts, your distribution will include a prorated amount of after-tax and pre-tax. The QCD is an exception to that rule. Under the QCD, the pre-tax amount comes out first. There's no pro rata rule here. So they take the pre-tax amounts first, and that's so you get the benefit of the pre-tax amount being allocated to the QCD, which makes it non-taxable. And if that amount that is sent by your custodian does include any amount in excess of the pre-tax amount, it's reported on your income as a non-taxable distribution. But if you itemize, you can claim the deduction. So, Louis, taxpayers have to communicate with their tax preparer. You can't just say, here is my 1099-R. Now, 1099-R is the document that the custodian issues to the IRS and the IRA owner to say, this is the amount that you withdrew from your IRA during the year. They have to tell the accountant, well, how much of that was a QCD, so that the accountant knows how to treat it on their tax return. And we're going to be talking more about that later on. So I'm looking forward to your comments. But before we move on, do you have anything that you want to add to this slide?
On that basis, are you looking at the aggregate, or are you looking at the individual account? So you have an IRA, you have a basis, and you have another one that you don't, and you make a distribution from the one with basis. Is just the income going first, or do you look at the aggregate of all of them?
Excellent question. So let me just ping the audience about what you're talking about. If you have 10 traditional IRAs, in order to determine how much of your distribution includes pre-tax amounts and after-tax amounts, all of your traditional IRAs, SEP IRAs, and simple IRAs are aggregated and treated as one big old traditional IRA. And the same thing applies for your QCDs to determine how much is attributed to the pre-tax portion of your traditional IRA. All of your traditional IRAs, SEP IRAs, and simple IRAs are aggregated and treated as one.
And the point being, if you had one IRA that you had basis, you could not make distributions for that non-basis to get it down so you don't have any basis in that particular one.
Exactly. And people ask me all the time, Denise, can I put my basis in just this IRA and then convert it so I have a tax-free conversion? No, you can't do that because the IRS looks at all of your IRAs as one big old traditional IRAs. Tax reporting, Louis. This is where I've learned so much from you. And here's the problem with the tax reporting. The IRS says to IRA custodians, oh, QCDs, report it as a regular distribution. If it's a traditional IRA, put the amount in box 1, total distribution, put the amount in box 2A, taxable amount, and check box 2B, taxable amount not determined. Now, it's only fair because custodians don't know your basis. They don't know, what you're doing with this money. They don't know if you're going to get a letter from the charity. And so it's only fair to them to make the requirements only what they really know. But when they check that box that says taxable amount not determined, it leaves it open for the tax preparer to say, okay, I'll determine the taxable amount. And it goes to what I was saying earlier. You got to tell the tax preparer so they know to report the QCD portion as non-taxable on the tax return.
The reason for that is the custodians, they can't verify that it is a qualified charitable distribution. For instance, I don't think we mentioned it, but you can't make a QCD to a donor advised fund, for instance. So they're not going to verify that, and that's the reason they just show it as not determined. It's up to you. And the real problem, Denise, that I see is clients make these QCDs to, let's just take the churches. That's one I see a lot of. The church gets the check. They report it on their giving statement along with other donations that the client has made during the year. So at the end of the year, the client gets a statement from the church, shows all the contributions they made, including QCDs. Then they take that to their tax preparer at the end of the year. And I've seen several different versions of what happened. I've seen where the CPA, he didn't know any better because he just saw a statement from the church and assumed that these were donations made by the client as itemized deductions and took them as an itemized deduction. Whereas you have to really split it up. The ones that were made from non-IRA funds would qualify as an IRA, but those other amounts that were QCDs, then you'd need to reduce the amount of the 1099 income from your IRAs so it doesn't show up on the front of your tax return. I have seen, I don't know how many errors, a lot, and it's really common, and it's hard to pinpoint whose fault is it? Is it the CPA? Is it the client? Sometimes it's a combination of the CPA not asking enough questions. It's certainly the fault of the client and not telling the CPA, I made QCDs and this included here, and here they are, because they get a copy of a letter, they have the records, so the client can do it. They just don't know to do it.
Yeah. And ultimately, if this goes wrong, it's the client that's going to suffer the consequences, right? So it is their responsibility, I agree, to communicate that information. The question becomes, how can the CPA help? Like, I know my CPA gives me every year she says, Denise, give me this, give me that, give me whatever. And what I encourage CPAs to do is to add more to that. Did you take a distribution from your IRA? Was any of this donated to a charity directly? And you got to spell it out. You can't say, was any of this donated to a charity? Because if they took it, put it in their checking account, donated to a charity, they're going to say yes. So you have to be very specific. Was any of this donated to a charity? And if yes, was the amount paid directly to the charity by the custodian? Meaning when they issued that check, was it made payable to the charity? And then you got to find out which charity is it. Because now you want to know if the charity is an eligible charity for the QCD rules.
Next question, do you have a receipt for it?
Yeah, exactly. So, when the IRS comes knocking, hey, I got a 1099-R. I see on your tax return that you're excluding it from income because it's a QCD. Show me proof. And when the IRS comes to do that, you want to say, well, here's my paperwork. Here's my acknowledgement from their accountant. And you could see, when they sign their letter, they cross their T's and dot their I's like this. Proof. But yeah, documented proof is a beautiful thing when it comes on to the IRS.
When you look at your tax return after it's prepared, I believe the line numbers, I believe it's the right number is 4A. 4A would show the total amount of the distributions that you receive from your IRA. And then you have 4B where you put the taxable amount, and then there should be a code on the front of the tax return that says QCD. So when the Internal Revenue Service is looking at your return, they're going to see the gross amount that's on that 1099, knowing that you did recognize how much you got, and then you're going to see the taxable amount as a different amount. And they're going to see a code that says QCD, which tells them the difference between those numbers or the qualified charitable distributions you made. And that's another area that I see a lot of errors is whoever prepared the return did not do that. I had one where they reported a very sizable amount of QCDs as taxable income.
Wow. Ouch. And so I love that point that you made. So let me high point it. 1099-R says 100,000, but 50,000 of that is QCD. The 100,000 is going to be included on line 4A of the 1040, your tax return. Only 50,000 is going to be included on line 4B. And to the left of line 4B, it's going to say QCD. And that communicates to the IRS like, hey, the 1099-R says 100,000, but only 50,000 is taxable. Why? Because 50,000 was a QCD. Yeah. Any final thoughts, Louis?
No, I just think so many people are not aware of the QCDs and the impact and how much it saves them. And they need to understand it and use it. Now, one of the things that you can do, I don't really recommend it too much, but you can get checks on your IRA and write a check to your charity, and they qualify. But you got to be really careful. One, that check, if it's part of your RMD for the year, and that check doesn't clear, you give it to your charity that say in December and doesn't clear, then you haven't satisfied your RMD. So we have clients that they give a lot of different charities, and rather than requesting funds, and it's just administrative, it's just a lot easier for them to have a check, but you got to be real careful with it. And I don't know if all custodians do that. I know, for instance, Schwab does that, where you actually have what we call an IRA checkbook.
Yeah, that is such an excellent point. Because here's something else to think about that we had mentioned earlier. If you write the check and it's not cashed, then it doesn't count as a QCD or RMD for the year. And that's my wrap-up point. Make sure if you're using your checkbook IRA for a QCD, make sure the check is cashed by the end of the year. Go to the charity if you have to, take them to the bank and have them deposit that check. Otherwise, you could have an RMD shortfall. or a distribution that's a QCD for the following year instead of the year that you intended it to. Thank you, Louis. This was excellent. Such an important topic, and one of those topics that I get so many questions on. I'd love to have you back to talk about some of the interesting things that we talk about over brunch. Because when we have brunch and we have those conversations, you know, we always say, customers would love to know about this. And that's why we're here talking about this QCD now. It was an idea that came out of those delicious Cuban sandwiches that we had.
We can do that again. I'm always ready.
Thank you.